Hey folks, welcome to another episode of Financial QB TV, and today we're going to talk again from a book that we use here, Dirty Filthy Lies My Broker Taught Me, and 101 Truths to Money and Investing. And you can actually get this book from me if you link down to the link down below this video. But today we're going to talk about a word that is overused by investors and the financial industry, but it's also misused and misunderstood. And that word is diversification. Another component of diversification is asset allocation. Okay? So the real news is that when it comes to building a portfolio, especially one with exposure to equities, you do not need any of the traditional investing methods of market timing, speculation and gambling, or stock picking. As an investor, you must understand that the real substance of building a solid portfolio relies upon diversification and asset allocation. It's extremely important for you to also understand, and it's been proven, that over 92% of a portfolio's return is determined by asset allocation, while less than 7% of their returns are attributed to stock picking and market timing. That means, this important fact means, that you need to disregard as much of what you see in the media and what is often touted by most of the financial industry regarding investing. So what does diversification mean? Well, in simple terms, it means spreading your assets over a variety of different investments. However, to be truly diversified means much more than that. Real and proper diversification is based upon maximizing your return potential while minimizing your volatility or risk. Next to compound interest, diversification is one of your best friends. So let's look at an example of how it works. Simply owning a lot of stuff does not mean that you're diversified, and I see this over and over again. For example, you can own 50 U.S. blue chip stocks, okay, or any 50 stocks, okay, in any one asset class or even industry. Just because you own that much stuff or that many stocks doesn't mean you're truly diversified. Let's say you own 50 U.S. blue chip stocks, okay, and the S&P 500 drops 20%. It's very likely that your portfolio will also decline because you own all similar stocks. Very few investment portfolios that I see are truly diversified. Another common mistake that I notice with investors is that they may be invested in several mutual funds. I see this a lot with 401ks. They may be invested in a lot of different mutual funds with different names and objectives, or the top performing funds, which makes them believe that they are truly diversified. When the markets drop, to their horror, they lose a lot of money. This is because what you see is not often what you get. When it comes to active and portfolio management, many funds give their portfolio managers the freedom to buy whatever they want and go after whatever they want in search of that next best thing. So this often leads mutual funds to all be buying and chasing the same stocks, and therefore you actually get very little diversification. So it's very important that you maintain the correct investment philosophy when investing and building your portfolio. When it comes to true diversification, it's being different from your friends and neighbors that's important. Next time in part 2, I want to take a broader view of diversification when we discuss how to properly apply it as it relates to your portfolio. So guys, the book down there in the link, go ahead and get it. See you next time on Financial QB TV.